A single forged letter from Bank of America helped hide a $20 billion hole in Parmalat's accounts. In late 2003, the world watched as one of Europe's most recognizable food companies crumbled almost overnight. Parmalat was a dairy giant, a symbol of Italian excellence known for its long-life milk and a cheerful logo that adorned supermarket shelves from Italy to Latin America. To the public, it was a national champion. To investors, it was a safe bet. But behind the wholesome image of milk and juice lurked a labyrinth of deceit. When the smoke cleared, nearly $20 billion had vanished. It became one of the largest corporate frauds in history, earning it the nickname Europe's Enron. To understand how a milk company disappears $20 billion, we have to go back to 1961. Calisto Tanzi founded Parmalat in the small town of Calicio near Parma, Italy. His big breakthrough was the adoption of ultra-high temperature processing, or UHT. This technology allowed milk to remain fresh for months without refrigeration. It revolutionized the industry, turning a perishable local product into a global commodity. Under Tanzi's leadership, Parmalat expanded aggressively. By the 1980s, it was acquiring companies in Brazil, the United States, Venezuela, South Africa, and Australia. It wasn't just a business, it was a brand. Tanzi sponsored the local football team, Parma A.C, and invested in cultural projects. By the early 2000s, the company operated in 48 countries with over 200 subsidiaries and 36,000 employees. On paper, it was a triumph of modern capitalism. But the appetite for expansion far exceeded the company's ability to generate real profits. The dairy industry has notoriously thin margins, and Parmalat's aggressive growth was fueled by massive debt. By the late 1990s, a strange contradiction emerged. Parmalat's financial reports showed strong revenues and billions in cash reserves. Yet, despite supposedly sitting on mountains of cash, the company continued to issue bonds and borrow heavily from banks. In a healthy company, if you have billions in the bank, you don't keep borrowing at high rates. This was the first red flag, but the world ignored it. The truth was that Parmalat's cash did not exist. Its debt was far larger than disclosed, and its loss-making operations were hidden behind a veil of offshore subsidiaries. To maintain this illusion, Tanzi and his inner circle orchestrated a sophisticated web of deception. They used circular financing, where one part of the group would sell to another, creating paper profits that didn't exist in reality. They used shell companies in the Cayman Islands and Luxembourg to shift liabilities off the balance sheets. They even used complex derivatives, financial instruments used to hedge risk, to instead disguise losses, deepening their exposure while pretending to protect it. When Italy passed laws in 1999 requiring auditor rotation to prevent too close relationships, Parmalat simply shifted key subsidiaries abroad to keep their familiar auditors, a tactic known as audit arbitrage. The centerpiece of the entire fraud was a single piece of paper. It was a confirmation letter, purportedly from Bank of America, stating that a Cayman Islands subsidiary called Parmalat held nearly €4 billion in a single account. This letter was the cornerstone of Parmalat's credibility. It was the proof provided to investors and auditors that liquidity was abundant. In reality, the letter was a crude forgery, created using a scanner, a Bank of America letterhead, and a desktop printer. For years, this one fake document kept the empire alive. The charade finally broke in December 2003. Auditors demanded independent confirmation of the Parmalat cash balance. When they contacted Bank of America, the bank simply denied the account existed. Within days, Parmalat admitted the documents were forged. The company's stock was suspended, and within a week, it filed for bankruptcy protection. The scale was staggering: €14 billion in fabricated assets and a hole of nearly $20 billion. The fallout was immediate and brutal. Founder Calisto Tanzi was arrested on Christmas Eve 2003, pulled from a first-class seat on a flight from Lisbon. He was charged with fraud, market manipulation, and criminal association. Investigators discovered the company had been treated as a private family fund, with at least €800 million siphoned off to Tanzi family businesses, including a tourism company called Parmalat. In 2010, Tanzi was sentenced to 18 years in prison, later reduced to 10 years on appeal. 14 other executives and advisors were also convicted. But the human cost was the most devastating. More than 135,000 retail investors, many of them Italian retirees who viewed Parmalat bonds as safe savings, saw their investments become worthless. Even the football club, Parma A.C, plunged into financial distress, forced to sell its star players to survive. Because the fraud was so systemic, the Italian government had to intervene with an emergency measure called the Marzano Law. This allowed Parmalat to undergo extraordinary administration, rather than standard bankruptcy, aiming to save jobs and preserve operations. Enrico Bondi, a turnaround specialist, was appointed as the extraordinary commissioner. He spent years fighting legal battles across borders. In one landmark case, the European Court of Justice had to decide if a financing arm called Eurofood belonged to Italy or Ireland, eventually ruling it was based in Ireland. Bondi also took on the giants who enabled the fraud. He sued banks and auditors, arguing they ignored obvious warning signs. While a New Jersey jury rejected claims against Citigroup, other firms settled. Deloitte paid $149 million and Bank of America paid $100 million to resolve allegations of audit failures. By 2005, Parmalat emerged from administration as a smaller, viable company. Its journey as an independent entity finally ended in 2011 when it was acquired by the French dairy giant Lactalis. Parmalat didn't fall because it sold milk. It fell because it tried to turn a low-margin commodity business into a magic money machine through forgery and silence. It remains a stark reminder that when a company's reported wealth is inconsistent with its need to borrow, the numbers aren't just wrong. They are likely a lie.